Hello and thank you for joining. I'm Renzo Desbordes, Investment Director at Flying Colors. Today's quarterly update is about the opportunities in a mature cycle. I'll set the scene with what is a mature cycle. We will then look at the market optimism, AI as a structural growth driver, and finally, why diversification matters more than ever. My goal is practical: what to own, what to avoid, and what is in the horizon for us. Let's dive in. A mature cycle is a phase where markets are strong, confidence is high, volatility is low, but fundamentals are no longer accelerating. It is a period where complacency builds and valuation stretch. This is where we are today. If we look at this chart, the market reached another all-time high in 2025. That isn't unusual considering that the market rally started over 3 years ago. What's more telling is how smoothly market has continued to climb, with very little interruption along the way. That kind of steady ascent often reflects a growing optimism, but it can also be a sign of complacency creeping in. When market rises consistently, investors are assuming a very stable path ahead, one where nothing really goes wrong. This does highlight a classic mature cycle pattern: strong performance paired with increasingly confident expectation. And that is historically when bad surprise hurts the most. Now, there is a reason why markets have become so optimistic. A big part of it is the fact that AI is a major game changer, something on the scale of the internet in the 2000s. It can transform productivity, profitability, and long-term growth. But at the same time, we have to acknowledge the other side of the chart. Valuations have moved sharply higher. So yes, AI may well be another technological revolution, but markets are already pricing a lot of that optimism. That also means expectations are becoming increasingly stretched. And when expectations are that extended, markets look for opportunity elsewhere. What really stands out is how strongly markets outside the US performed in 2025, their best relative showing since 2009, highlighting that opportunities are no longer concentrated only in US technological stocks. To put it into another way, being diversified paid off in 2025. And we saw that in Q4. UK, Europe, EM, and Asia delivered a very strong quarter, actually outperforming the US equity. A meaningful change from the pattern we've seen in recent years, where US large cap stock dominated. And this rotation isn't limited to equity. Gold was one of the standout performers, outpacing all traditional fixed income assets. And that reinforced the message we've been highlighting for some time. Diversification matters again, and being passively invested is not good enough anymore. In conclusion, while easing inflation and peaking interest rates provide a more stable backdrop for markets in 2026, meaningful risks remain. Elevated valuation in the US stock market, fiscal pressure in Europe and in UK, and geopolitical uncertainty reinforce the need for a robust approach. That is why we continue to highlight the need to look beyond traditional asset allocation. We are being selective in sovereign bond, broadening diversification, and focusing on resilient portfolio will deliver stronger risk-adjusted return over the long term. As I have talked about investment, I must remind you that capital invested is at risk and future performance cannot be guaranteed. If you have any question or comment, please contact your financial advisor. Thank you for your attention.